at So again, this is Chandra Tanner, the Director of Mortgage Originations at Self-Help Credit Union, with some new programs to tell you about. And you can also ask any questions about getting a mortgage also at the end. So we'll take plenty of questions. And so I'm going to stop talking and let Chandra start.
Mute. Okay, there we go. I think I'm off mute now. Can everybody hear me? All right, good afternoon. How's everybody doing? I can see a few faces. I can see the thumbs up, so that's good. Thank you for doing that. I wish I could see a few more faces, but I understand if you've got stuff going on in the background and you don't want to show your beautiful faces. It just kind of helps me as I talk to just see people's reaction, and that way I can kind of gauge if there's questions or if you're getting me or if I'm way off base and you're not understanding what I'm saying. So if you could show your face, it would be great. It would give me some energy. But my name is Chandra Tanner. I am the Director of Mortgage Originations for Self-Help Credit Union. I've been doing this now with Self-Help Credit Union for 21 years. And before that, I worked at Wachovia. You may have heard of it. They merged, and so they no longer exist, but was with them. So I have quite a bit of experience in helping folks like you become homeowners. And so what I'm really excited about tonight in presenting to you guys is that Larissa and I just did this maybe 2 or 3 months ago. And I emailed her this week to say that we had a buyer that was on a call, just like you guys are, close on her home last Friday, her husband, and her 2 children. So I'm hoping that off of this call, this meeting, hopefully we'll have some of you actually become homeowners with us as well. So again, thank you for being here. A little bit about self-help. Not sure how many people know who we are, where we're located, but we are in downtown Durham. You may have seen us, the big tall building on Main Street. And then we have a couple branches, one on Main Street and then one on Mangum Street. We merged with what was Generations Credit Union and then Greater Piedmont Credit Union. So we merged with them and they all came up under self-help. My office is located at 301 West Main Street. So what I'd like to do is to talk to you a little bit about what lenders look for when we're doing a mortgage. And then towards the end, I'll talk about some of our unique products that I feel like are really good and that are not being offered by any other lenders. And of course, if you have questions, please stop me mid-sentence and ask your questions, because I'm here to help you. And I want to make sure the information I'm giving to you is what you want to hear, because I can ramble on all day. I'm a talker. Feel free to ask your questions in the chat or either just blurt in. I don't mind that at all. Interrupt me. But let's first talk about mortgage lending. All right. What is a mortgage loan? Does everybody know what that is? So I will ask questions and then I need y'all to shake your head or give me thumbs or something to let me know I'm right on base here. So a lot of folks are really scared to become homeowners. A lot of people are just really nervous about trying to become homeowners. But what you guys are doing is awesome, because you're actually learning about home ownership and the steps that you need to take in order to become homeowners. Y'all have taken that first step. Mortgages are not a bad thing. They're not terrible. It's not hard to get. You may have to do a little bit of work to get it, but it is possible for you to get a loan. Home ownership is achievable regardless of your situation. You just have to put your mind to it, dream it, and you can make it. A couple things when people come to us, the first question they always ask is, well, what do you need? And I'm like, okay, that's a good question, right? What do you need? What is it? What's the process? When you decide to become a homeowner or to pursue a mortgage loan, the first thing you want to do is talk to a mortgage professional. Right? You go to them, you let them know you're interested, and then they're going to give you a list of items that is needed in order to pre-qualify you for a mortgage. So what are some of those documents that you need to have on hand? You need to have, of course, your pay stubs, right? Because we're looking at income, your tax returns, your W-2s, right? You need to have bank statements, the last 60 days bank statements. We usually look at 30 days pay stubs, 60 days bank statements, any other income documentation. So if you're getting Social Security income, then we ask to see your awards letter that you get from Social Security. Or if you're getting like child support, then we want to see maybe a letter from the Child Support Enforcement Agency. Or if that child support is not court ordered, then maybe you have checks that are coming to you. So maybe you start keeping copies of the checks that are being sent to you for the child support. We ask for your rental history. Are you paying rent? And if you're paying rent, how much are you paying for rent? And can you document that? Is it through a third party or is it to a family member? And I'll get into that a little bit later. We usually like to see your current driver's license, some sort of identification, your Social Security card or taxpayer identification card, if you have it. And then from there, what we can do is take all of that information, put it together. We pull your credit. We look at your income compared to your debt. And then we tell you how much of a loan you pre-qualify for. Okay. So those are that's the documentation we need. Now let's go through the different things that we're looking at. So why are we asking for your pay stubs? Does anybody know why we ask for your pay stubs, your tax returns, and your W-2s? I can't hear you, Denise.
I'm sorry. To verify income.
That's right. So we want to make sure that you have enough income to support your mortgage payment, right? Mm-hmm. We want to see if you're paid hourly or if you're paid salary. And if you're getting paid hourly, how many hours a week are you working? How many hours? What is your total income for the year, right? So we ask for the pay stubs, your W-2s, your tax returns. We will also do a verification of employment. Once you make it through the pre-qual process and you're under contract, then we will contact your employer to make sure that you're still working there, that you have a good employment history. Okay, so we got to have income. The second thing that we look at is your credit. So the biggest challenge for a lot of people is credit. And a lot of people don't understand what credit is or how the credit score is calculated and things like that. I've been in the business now for 25 years and I still don't know what goes into calculating a credit score. Like there's like some out of space calculation that they do. All I can tell you is that credit scores range from 350 to 850. And the higher the credit score, that means you have a better credit rating. The lower the credit score means you've had some credit challenges and you might need a little bit of work, okay? So the higher the credit score means you're a less riskier borrower. So you have credit, you pay your credit on time, you understand how to use credit, you're responsible with your credit. That equates to a higher credit score. A lower credit score may mean you may have some collections, you may have some late payments, you may be over limit on your credit card balances. So therefore your credit score means, you know, you may be a little bit more riskier to lend to. Fortunately at Self-Help, we work with borrowers with a 580 or greater credit score. So we do work with people that have had some credit challenges, some bumps in the road, but that have, you know, worked to kind of get things a little bit better. We like to give you a second chance, okay? What are some things that affect your credit? Does anybody want to answer for me? What are some things that can affect your credit score? Yes, Rosanna? Oh, you weren't raising your hand? Oh, sorry.
Well, no, but that's okay. I mean, let me think.
Okay.
You have too much, used up too much of your credit card balance.
That's exactly right. So what if you have a credit card balance of $1,000 and well, the limit is $1,000, but on your credit report, it shows that your balance is 1,050. That means you have exceeded your limit. And when you exceed your limit, that really impacts your credit score. It makes your credit score go down. That is not good, okay? Usually what we tell people is if you have a credit card, you want to try to keep your credit balance or your balance on the credit account no more than 30% of the total balance. So if you have $1,000 balance, 30% of that is $300. So you want to try to keep your running balance at $300 or less. Does that make sense? Okay. All right, good. And sometimes it's hard to do that. Sometimes we have emergencies and we have to use it and we have to take it over that 30%. That's okay. The goal of it is to try to get it back to below that 30% so that your credit score can continue to be good. And Larissa, if I'm saying anything incorrect or something that you want to jump in on, please feel free to do so, because you're definitely the credit expert.
Well, Angela really is, but I'm following in her footsteps. There's a couple questions. Well, one comment, someone said another thing that affects you is late payments.
Oh, yes.
That's a good one. And someone asked in general, what are credit requirements for mortgage loans? So you mentioned your credit scores start at 580, but are there other requirements? What are they looking for?
Yes. So let me just talk on late payments. Okay. When you come to a mortgage lender, the thing that we don't want to see is that you are unable to maintain your current debt that you have. So going to a mortgage lender with the late payment within the last 12 months on your credit report tells us, oh, they may be struggling to maintain their current credit limits or credit. So do we really want to give them more credit, right? They're not able to maintain. We don't want to give them more. Yes, Rosanna.
This time was for real. So let's say that I forgot. And that happened to me. I have forgotten to make a payment. I mean, it's not like the debt is like a lot of money. It's just that I forgot. And then it happened once a year or twice. And then you said within the 12 months, is that gonna be bad?
Well, it could affect your credit score and the lender could look at you and say, what happened? So we do accept explanations. So if you come back and say, okay, Chandra, the reason why I was late was because I was sick that week and I forgot to make the payment, and you only have one, then it's like, okay. And the other credit history is fine. That was the only one late payment on the account. Chances are you're going to be okay. But if we see multiple accounts that are paid late more than once a year, then we're going to start to question that. Okay. So one, you can explain. Larissa, the question and what was the question again?
Well, there was a general question, but I did want to address that. There was a Duke homebuyer who said the best thing she did was to put her credit card on auto pay. So when you want to build credit, you just have use it for one little bill, as little as you can get it. And then if you are able to maintain a balance in your bank account, just have the bank pay it off or your credit union pay it off each month. And then you're never late.
That's an excellent point. Everything I have is basically on auto draft. So that I don't risk doing that. Well, the bigger bills, everything that's bigger, the mortgage, everything is on auto draft. But yes, definitely use auto draft so that doesn't happen. I know a lot of folks sometimes around the holidays, it tends to get a little bit hectic and our lives are really busy. And we're out shopping and spending money and we forget to make some of those payments. So around the holidays, we see a lot of people start to accrue or incur late payments. So especially around the holidays, you want to make sure you're paying attention to that. If for some reason you don't have traditional credit on the credit report, then lenders can also accept alternative credit. Do y'all know what alternative credit is? Alternative credit. So let's just say you've had some credit challenges. You've decided that you want to pay for everything in cash. You don't want the credit card. You don't want the loan. That's not going to stop you from getting a mortgage, right? lenders can also look at alternative credit. Alternative credit being, how do you pay your electric? How do you pay your cell phone? Are you paying your water on time? Can we get a credit reference from your car insurance? And so what we see is people that say, okay, well, my electric is not late. I don't have any cutoff notices. What we're looking to see is if you paid that account by the due date. So if Duke is saying you need to make your payment by the 4th of every month, we're looking to see that you made it by the 4th, not the 15th, not the 20th, because at that point, anything after the 4th is considered late. So if you don't have the traditional credit on your credit report and the lender accepts alternative credit, be prepared to provide credit reference letters from Duke, telephone, car insurance, any utilities that you have. Okay.
I have a few questions. Self-help credit union accepts explanations, they wrote. For example, someone's attending to a family medical issue and forgets, or if you're only 2 days late, a credit card company lowers your score. And so how can you address those?
Yeah, so if you have a medical issue, if your family's dealing with a medical issue and you forget forget a payment, then that's acceptable, right? If you have multiple times during that year that you're not making the payment, then that's just not like a one-time incident, right? Then that's not the exact same thing. We don't mind, having an explanation and make an exception. But if you've been consistently late and it's not just on one account, but all accounts, that's a little bit different. If you're a couple days, I think if you're 2 days late, a credit card company lowers you. I don't think credit card companies will lower your credit score if you're 2 days late. I think if you're more than 30 days late, and Larissa, you can help me with this. If you're more than 30 days late, that's when it actually reports to the credit bureaus. Okay, so if you're a couple days late, you're going to be okay, I think.
Yeah, they'll charge you a late fee, but usually the credit bureaus track whether you're 30 days late. I think you're right on that. And there was a question before that. How do you look, how does the credit union look at your older things on reports? Like if you had a car repossessed 4 years ago, and if you paid it, is that good? Or
yeah. Yeah, so for self-help credit union, we're a little bit different. If you have collections or accounts that are over 2 years old, we generally do not require those to be paid off. If you have collections that are within the last 2 years, but are lower than $250, you don't have to pay those off. What we're really looking at is mainly the last 12 months of credit history. Okay, we want to see that you don't have any late payments within the last 12 months. Now, not saying that we can't do a loan for you if you've had late payments in the last 12 months. It just may mean that you may have to contribute more money towards the down payment. So instead of you qualifying for 100% financing, you may have to put 3% down or 5% down or 10% down, depending on the credit. Okay.
And did everyone catch that? Collections more than 2 years old. And when you say 2 years old on the credit report, you look at all the dates, make sure they're at least 2 years old.
Right. We look from the date of last activity.
Date of last
activity. So if that activity is greater than 2 years old, generally we don't require that to be paid. Now, I can say that it really depends on how many of those accounts you have, right? So if you have $40,000 worth of unpaid credit that just happened in 2019, then that very well could be an issue. And chances are your credit score is going to be lower anyway. So it may be that you may have to put down a larger down payment. Keep in mind that those collections do affect your credit score. recent collections really affect it. And I have learned recently that even recent medical collections actually affect your credit score as well. So if you have gone to the doctor and they send you a medical bill, you know, even if you can't pay it now, then you might want to think about setting it up on a payment plan so that that collection does not hit your credit report while you're trying to buy a house. Okay. If you have a lot of collections on your credit report, a lot of medical collections, you may want to consider maybe setting up payment arrangements to pay those off, because the goal is to try to get your credit as good as it can be so that your credit score is as high as it can be so that you can get a much lower interest rate. Our interest rates and a lot of lenders' interest rates are based on credit score. So the higher your credit score, the lower your interest rate. The lower your credit score, it means you're more risky, the higher your interest rate. So you want to try to present the best possible picture as you can, and pay things off if you can. Okay. Oh, I see someone just put a question in. I bought a new car in November. How long should I wait before trying to work on getting a mortgage since it's a relatively new purchase? So your car loan is going to be opened for 12 months in 2021. I think you're fine to pursue a loan right now. We don't require accounts to be open for a certain amount of time. Obviously, anytime you take out new credit, your credit score immediately takes a hit because you're getting new credit. It's a new account. It's too new to rate. So your credit score will take a hit and will drop. And then the longer you pay on that account, you'll gradually see that your credit score will increase again. Do you add that monthly payment? Yes, ma'am. Do you add that monthly payment when calculating income debt? So let's talk about debt to income ratios, because a lot of people don't understand that. And I think that if you guys understand that, you're on the way to home ownership. So does everybody have a calculator, a cell phone or something? We're going to calculate your debt to income ratio. Or first of all, we're going to show you how we calculate income, how we look at calculating your income for the debt to income ratio. So everybody's got their telephone, right? Okay. We're going to use a debt to income ratio of 41%. 41% means your house payment plus your car payment plus your student loan payment plus your credit card payments, whatever debt you have showing on your credit report cannot exceed 41% of your total income. So let's start with an income of $3,000, all right? Or you can use your own income, whatever you want to do, your gross income. So I'll use 3,000 for an example. So if your income is $3,000 a month, what you're going to do is take 3,000 and multiply it times 41%. 3,000 times 41%, or 0.41. Can someone tell me what that is? $3,000 gross income times 0.41%. Anybody got the number?
Yes, Whitney got it. 1230. 1,230.
Okay, that's right. Good job, Whitney. So what that means is that your house payment, your new mortgage payment, plus any debt that you have, car loans, credit cards, student loans, cannot exceed $1,230 per month. Now, what if we have a car payment of $300? So we take $1,230 minus $300. That tells me that your house payment, whatever house you're buying, the payment cannot exceed $930 per month. Does everybody understand what I'm doing? We're taking 41% of your gross income, and then we're subtracting your debt that you're paying each month, And then that tells us, the lender, how much of a house you can afford. Now remember, that house payment also needs to include taxes and insurance. So that $1,230 includes your mortgage payment, which includes your principal, your interest, your taxes, and your insurance monthly. Okay? So let's do it again, but now let's use our own income. So does everybody know what their gross income is? Does everybody have an idea of how much money they're making each year?
I have a question.
Yes.
So if I have a co-signer for my house, then I need to add both our incomes together, or it doesn't work like that?
Is that co-signer going to live in the house?
Yes.
Yes, you would use both your income if that person is going to be on the loan.
But if they're not living in the house, it would be a different.
Yeah, so some lenders will accept a co-signer. Normally you'd want to try to do an FHA loan if you're doing a co-signer. At Self-Help, we do not accept co-signers because that co-signer is not going to be living in the house. They're not going to be contributing to the house payment.
Okay.
So we want to make sure that whomever's living in the house can afford that payment. Okay. So everybody, let's take your gross income. Does everybody have an idea of what their gross income is per month? Okay. Let's take that income and let's multiply that times 41%. All right. Now, once you have that number, subtract your credit card payments. So, do you have a credit card? If so, what is your minimum payment? Not the amount that you pay, but the minimum required payment each month. Okay? And then if you have a car payment, subtract out your car payment. Minus out your car payment. Do you have any unsecured loans? Do you have a furniture bill, a furniture payment? Do you have like a one main financial loan payment? If so, subtract those out. And whatever you're left with is the maximum amount of house payment that you can afford. Now, one thing about this is as a lender, we're using gross income. You guys are not living off gross income. I know I'm not. I know I got FICA, I got government, I got some Social Security, I got medical insurance. By the time I get my check, it's like, Lord have mercy, I done paid all them people and I ain't got nothing left. So what I want you to think about is when you're looking at realistically how much you can afford, keep in mind that your net income, the money that you're actually bringing in, that you're having to live off of, is less than what we're calculating your DTIs on. All right. So when you're thinking about a mortgage payment coming out of your net income, you also need to think about, I'm paying car insurance, I'm getting my hair done, I'm getting my nails done, I'm having to buy grocery. Y'all know grocery and stuff have gone up since COVID. I mean, it's just ridiculous how much you have to pay for a pack of hamburger meat, right? All of those things are coming out of that net income. So realistically, when you're trying to decide, okay, how much payment can I really afford? Think about it from the perspective of your net income, not what the lender is using. And then you'll be able to get into a home that you can realistically afford based on your income. Does that make sense? All right. Let's take it a step further. How much are you paying in rent? And if you're paying rent right now, are you able to save any money? So if you're paying $1,200 in rent, but you're saying, oh, no, I can afford a house payment of $1,600. That's a $400 difference. What you want to think about is, have I been able to save $400 extra per month? Right? Because you got to think about this. When you get this mortgage payment of $1,400 a month or $1,600 a month, that mortgage payment is going to be due every month on the 1st. Every month it's going to roll around on the 1st, and you don't want to pay it late. So if you're paying $1,200 now in rent, if you had an extra $400 a month to put to a house payment, wouldn't it make sense for you to take that $400 and put into a savings account so that then when you get ready to buy your house, you have some monies to pay down payment, to pay closing costs, to buy appliances, to buy furniture, to buy all the things that you need to go into your new house? So if you're saying, Chandra, I can afford $1,500, $1,600 a month in rent, then it would be great for me to see that you've been able to save the difference. Now, is it required? No, it's not required for you to do that. But I guarantee you, if you do that for a couple of months, you will really see if you're really able to make that $1,600 mortgage payment every month, right? Does that make sense? If you're not able to save that $400, then you may not want to get yourself into a $1,600 mortgage payment. And it doesn't have to be 16. It could be you paying $500, but the mortgage that you're getting could be $800. You can do the same thing. It's all relative. That's called payment shock. Lenders look at your payment shock. That's what it's called. Denise, you're smiling. Does that ring a bell? Okay, it rings a bell. Yep, that's payment shock. We look at that too. Let's see. Is gross what you bring? Is gross, I see a question. Is gross what you bring home or what you get paid before taxes? Gross is what you get paid before taxes and health insurance premiums. And net income would be deducting deducting everything, 401k, health premiums, taxes, all of that good stuff. Oh, I saw Larissa. I'm sorry. I see you just answered it.
We have somebody with a hand raised, Natasha Munn, I believe.
Okay.
Hi, what type of loan products do you have for households with SSID and court-ordered child support, but no employment income?
Well, you can qualify for the same program. It's all income. What we do with SSI is we gross up by 20%. If it's your SSI, so let's just say your SSI is 800, then we would take that and gross it up by 20%, which would be 160. So then your income would be 960 off of that SSI. If you're getting child support, then we have to see that the child support is court ordered, and that it will continue for at least 3 years. So with that, if the child is 15 years old, then we won't count it because
they're both under 10.
They're both under 10. Okay, so in that case, you wouldn't have any trouble with that.
Do you guys utilize the child tax credit programs that the state has currently? Like those little programs like that, the NCFHA programs? Or just on an individual basis, it's tailored to each family or whatever.
Right. So are you, so we would look at the child support and then we would look at the SSI. We would not include any other income for you.
No, what I mean as far as loan products for the mortgages, what specific programs do you guys use for, you know what I'm saying? Like I do know that for North Carolina, there is a child tax credit that can be used even after that child ages out towards the mortgage. And then there's the, maybe I'm saying it the wrong acronyms, but I think it's the NCFHA or NC. It's another credit or grant
it's the mortgage. It's the MCC, I think, the mortgage credit that you're talking about.
That sounds like it.
Yeah, so those programs can be used through North Carolina Housing Finance Agency. We don't have those programs at Self-Help.
Okay.
So everything that we do at Self-Help is our own programs. We don't offer FHA and conventional loans. They're our own portfolio loans. And where we're different is we make our own guidelines. We have our own interest rates. Our loans don't have PMI on them.
Okay.
FHA conventional loans tend to have
Yeah.
PMI if your down payment is less than 20% is less than 20%. So we're a little bit different there. But North Carolina has some great programs. North Carolina Housing Finance Agency has some great programs.
They do, but do you guys have any grant monies or down payment programs that currently, I know sometimes in the beginning of the year, you guys have access to funds and then they run out by February.
Yeah. That's called the Federal Home Loan Bank of Atlanta. I'm going to go ahead and share my screen right now, if that's okay. You guys
That's
let me
fine.
know
Okay.
if y'all can see it. So we do have, can y'all see my screen?
Yeah.
Okay. We do have down payment assistance through Federal Home Loan Bank of Atlanta. At the beginning of the year, usually around January 15th, they replenish their funds and then everybody's pulling off that money. Last year, the money ran out by like April or May. It really hurt us last year. That's why it's so important for you to get ready for home ownership now in October and November, so that when those programs roll out in the new year, you're ready. You're ready to actually buy. So start now. We can use those programs. Self-Help also has some new programs that we created that you can see on my screen. This first section, the green under standard, is our normal Port 97 program, 3% down, no private mortgage insurance. Does everybody know what private mortgage insurance is?
Yes.
Okay. Our loans don't have private mortgage insurance, which in some cases I think is better than having a loan with PMI. And I know it's 6:15 right now, so I'm trying to be mindful of the time. A couple of the programs that we have, we now can go up to 100% with a 620 or greater credit score. We can actually finance closing costs in our loans with a maximum LTV of 105%. So that means you are getting 100% financing, plus you're getting 5% to help you pay closing costs. Okay. That's our new Equity Boost program here. So we've got a couple of programs under the Equity Boost. One of them is based on 80% or below of the income. You have to have 80% or below, be 80% or below the area median income, and there is a purchase price limit. Well, when we came out with this program, we're using some federal dollars, and because of their limitations, we felt like we needed to create something for the people that were over the 80% area median income. And so that's when we came out with our first generation loan. This is a loan that is using Self-Help's money as down payment assistance. This is not backed by any foundation or government or Federal Home Loan Bank or anybody. It's Self-Help's own money. And what that particular program allows us to do is it allows us to work with first generational homeowners. So people that have not owned a home within the last 3 years, and then folks whose parents have not owned a home before. So if you are going to be the first person in your home, in your family to purchase a home, and your income is greater than 80% of the median income, but below 120, you very well may qualify for this first generation Homebuyers program. And that is brand new.
Do you mind sharing what that cap is for the limit for the house or the property you can purchase?
So for Durham, I'm going to stop sharing my screen because I don't know what I've got back here that's open. So you guys are in Durham. So bear with me here. I guess I should have had that up. It shouldn't take me long to find it. And y'all let me know if I'm starting to ramble, if I'm not making any sense, okay? For Durham, the limit for a household of 4, the income limit is 69,100 for the 80% or below. So 80% or below, 69,100. For the purchase price limit, it's 260. 260 for an existing construction. If you're buying for existing home, if you're buying new construction, the purchase price amount, why is that not working?
Do they have properties on the market at that price in Durham?
It's hard to
No.
find right now.
Do you have a table that show the counties of North Carolina? Because I know you guys cover everywhere, just in case. I know me in particular, I'm not looking in Durham. I'm looking outside in more affordable areas.
Sandra, I can send that, Natasha, I can send that to you, but a list of all the counties with the income limits that are right now. And
As it relates to self-help?
well, you're using the HUD
We are.
guidelines. Everyone uses
Okay.
the HUD guidelines.
Okay.
So I can
Okay.
send you that chart, and it has the sales price for existing and new. I think the
Good
new
deal.
ones in Durham, it's only 261. It's about the same.
It is. You're right, Larissa.
Larissa, this is Vandora. Can you also send that to me as well?
And Lynetta Hughes as well, please.
Yeah, see, we all want it.
Me too, me too.
Affordable housing is not in Durham. 260 doesn't exist anymore.
So
Very rare. That's a rare
If-
number.
if you want to purchase something outside of the 260 and you are a first generational home buyer, then there is no purchase price limit.
Oh, great.
So we have something to fall back on, right?
Okay,
So
great.
if you are outside that 260, then we can switch you over to that program, and then you're still eligible for those benefits.
Wonderful.
All right. And guys, I don't know if you really understand what I'm saying about being able to finance closing cost. So typically down payments would be 3%, and then you would have probably another 3 to 5% in closing costs.
Right.
That could be up to $8,000, right? That you would need
Right.
out of pocket. At self-help, we can go up to 105%, which means instead of you needing $8,000, you very well may need only $2,000 to buy your house.
Good. Not including the inspections and all of that and appraisal.
That $2,000 would include inspections, appraisals, whatever.
Great.
Yep.
That's a blessing.
Yeah. Like I said, we just closed one for one of Reinvestment Partners, customers just like you, and they bought a house out in Eflin, beautiful home, and they ended up coming out of pocket probably with $3,000 or $4,000, and they bought their home was like $225. $230, and they ended up getting a home with not a whole lot of money out of pocket at a very good interest rate as well.
Good.
Nice.
So
That's hopeful.
yes. And one thing about self-help, so, you know, if for some reason you come to us and you don't qualify, then what we like to do is we like to tell you what you need to do in order to qualify. We don't just say, nah, we can't do it. You know, we've actually put people on plans and said, okay, do this, do this, do this. And then if you do what we ask you to do and come back, then we'll be able to do a mortgage loan for you. So we don't just send you away, you know, with no hope. We try to give you hope, and then it's up to you to work to get to where you want to be.
Quick question, last question, Ms. Tanner. Can I schedule an appointment with you to do that? Because I want to buy by December or January, and I know that I have great repayment history. Everything is fine, but my credit score has gone down because my utilization is over 40%.
Okay,
So it was 746 the last time I saw you guys. It's right at a 620 now
okay,
because of that utilization.
okay. And you've been to self-help before?
I have.
Oh, okay. All right, well, of course you can call me and we can set something up.
Okay, good deal. I'll make contact with you in the morning.
And tell me your name?
Miss Munn, Natasha Munn.
Natasha Munn. Okay, okay, Miss Munn. That sounds good. What other questions do y'all have? I hope this was helpful. Let me look at my list to see if there's anything. Savings, y'all know y'all gotta have some savings, right?
Yeah.
Yeah.
All right, everybody knows they gotta save some money because you're not gonna be able to get into a house with no money down. You gotta pay for inspections, upfront appraisal fees. And I'm gonna tell you right now, these due diligence fees that these agents and sellers are requiring is just absolutely insane. It really is tough for first-time home buyers in this market, but hopefully things will start to improve.
One person has their hand raised. I think it's Jasmine. The Zoom, it says iPhone. You're
And
muted.
someone, Chandra is asking if we can get your contact information. So what do you want me to share on chat and send out to people? Or do you have a person who can help people with, getting more information about these new loans?
Let me,
So just send it to me later. And I'll
okay,
send it out to everyone, whoever you want them to contact first.
okay. I've got quite a few people out right now, so I'm trying to, the main day's taking me a minute, but we're getting to them. I just put my telephone number in there and my email address.
So you sent those to me directly?
Yes, what I'll do is I'll also email you our brochure,
Okay.
which has our loan officer's contact information on the back. And then I'll include my information in the email as well.
Perfect.
Larissa, can you please make sure that I get that also? I'm sorry, this is Pandora.
Yes, I
The
got that.
contact info. Thank you.
Chandra, is that Gilberto? Is he still the person to contact along with you?
Yes, Gilberto, Sharita, or either me.
Rita, okay.
Gilberto just got married last Saturday, so he's on his honeymoon. So, and unfortunately, Sharita has
Hey, my workroom.
Huh? Oh, she may not be talking. And then Sharita's out sick, so it's
Well,
just me right now.
This is Miss Munn again. I don't want to put too much of my personal information on broadcast, but I'm specifically looking to work with you.
Okay, that's fine.
Okay, so I will be shooting you an email or leaving you a voicemail this evening so that I can get in as soon as possible.
Okay, that sounds good, Miss Munn.
Okay, you guys have a great evening. Thank you much.
Oh, I want an appointment with you too, Miss LaShondra, please.
Okay.
I sent you info in the chat.
So,
my name is Leslie Neidick, and I've been working with the First Time Home Buyer Club with Larissa. And I need to make an offer on a $224,000 for sale by owner house in the next 2 weeks or so. Or maybe, well, no, I shouldn't say that. She'll hold it for me because she's a friend. But I'm a 25-year plus self-help credit union member, and I'd like to meet with you, if I can, sometime in the next 2 weeks, maybe.
okay. I like to do things via email first, so we can do this, or either you can email me your documents, and it's a lot faster.
Whatever you need, I'm kind of ready, because this came up. A friend of mine selling her house. She's moving in with her husband.
Can you send me an email so that I can forward you our application and list of items needed?
Yes, ma'am. Would you put your email in the chat?
Yes, ma'am. It's there. I think I did it.
Okay, thank you so much.
Okay. I look forward to talking to you.
Thank you, ma'am.
Miss Tanner,
Yes.
I have a question for you. When it comes to the credit cards, I had a coworker tell me how she built her credit, and I was just wondering if it was true. She told me she got a credit card with a limit of like $4,000. So like all her bills in her house for like the month ranges up to like maybe 28, she said. So she pays all her bills on her credit card, which is over 30%. However, she uses her checks to pay them off. And she said that helped her credit. But I was iffy about it because I was like, well, you're using more than 30%. But she said it made her credit jump a lot. So do you know how that works, or if that's even true? Or because I did see her credit, and her credit is pretty good. It's like 805.
And how long has she had that account opened?
She said she's been doing that now for like maybe 10 or 12 years.
Oh,
She said, yeah, she's older than me. And she said she used to have, she got divorced. She had kids. She had to take care of them. And, she was doing to try to stay under 30%. And she had a boss that she worked with tell her, look, this is what I do. And she said she tried it. And that's how she, and she said she's been doing that ever since.
so chances are, because she's paying it off monthly, that's what's helping her. She's using it and she's paying it off monthly. I can see that helping to improve her score. Chances are too, it's longer term credit. So she's had it for a very long time. She's been doing it that way for a long time. So I'm pretty sure the longevity is also helping to put her at an 805 credit score. Larissa, what do you think?
Yeah, I think it may be the longevity. What I find works best for people is to use the credit card every month. You want to keep using it with a very, very small bill. And what I see with our credit analyzer and with what people do if they follow this direction is to just bill something between $1 and $10. What I've found is the smaller the balance that's reported, the better, but you want to show that you're using it. So don't pay it, you don't charge the credit card and pay it the next day. You wait until just before it's due, so the lender can see you're using the card, or the credit bureau can see you're actually using the card every month with an extremely small balance.
Okay.
But if you have long history, one more tip. One of the best ways to help young people get started is let them be an authorized user on your credit card, but don't give them the credit card. And if you have someone who's older, you can trust, but being an authorized user with someone who's had credit for years, a credit card for years and years can really help. Chandra, there was one question that we didn't get to that I think is important. When you go to a lender, what should you be doing about your student loans that have been deferred?
So we're a little bit unique. I think FHA just changed their policy with student loans this year. So I can tell you what we do with student loans. We are able to use repayment plans for student loans. So if you are on an income-based repayment plan and your student loan payment is 0, we will count 0 in your debt to income ratios. Some lenders will use 1% of your mortgage loan of your student loan balance. Some lenders will calculate their own payment. But for us, we have to count some sort of payment. So even though the account is in deferment, it's deferred. The loan is not going to be deferred for 30 years. So that's why lenders want to be able to count some sort of payment on those student loans.
The one you had.
So for us, we can work with you if you're on an income-based repayment plan.
You really do need to make sure your loans have a payment on your credit report. So get busy now, making sure that your loans are all in payment, even if it's a 0 payment. The lender needs to know what the payment is. One other thing, Chandra, you talked about interest rates. Can you tell people about some of the programs you have that help with interest rates?
Yeah, so we have, so our rates are based on your loan to value and your credit score. So the higher your credit score, the lower your interest rate. The more money you put down, the lower your interest rate. But we have a couple of these programs, funds that we've received from our partners that we're actually able to lower your interest rate. So we have a program that is geared towards single parents with dependents. So if you're a single mom with dependents, then we have monies that can help buy down your interest rate. Our First Generations program actually will allow you to get a lower interest rate. And then our Capital Magnet Fund program will allow you to get a lower interest rate as well. So we do have ways to get your rates lower than what the standard rates are, as long as you fit those guidelines. And again, I think what's important to know is that when you're purchasing a home, it's not always about the interest rate. It's about what your payment is. And so even though Chandra may be saying, oh, your rate is 4%, FHA may be saying, oh, your rate is 3.75. Naturally, you would think, oh, let me just go with the 3.75 because that rate is lower. But you got to compare the payments, because that program has private mortgage insurance added in. Our payment does not. And so chances are, when you compare our payment with the payment with the lower rate, our payment very well may be the same or even lower. There may not be much of a difference. So don't always look at the interest rate to determine or to decide if that's the better program. Okay, look at the payments, and I think with PMI, you know, that private mortgage insurance protects the lender in case you were to default on the loan. So there's really no benefit to you in having private mortgage insurance. It's all to benefit the lender. So if you can avoid getting a program with PMI, that would be the way that I would go. Now, some programs, you know, they're good. You need the benefits of it. Then PMI is fine. I just think you need to just kind of look at the two and compare and see which one best fits your needs.
And I would back Chandra up on that. If you go to a bank and they say, oh, the only thing you can qualify for is FHA, definitely check out Self-Help Credit Union or another credit union, because the FHA, that mortgage insurance, lasts for the whole term of the mortgage, for the whole 30 years. If you pay the whole mortgage or however long you have that mortgage, you're going to have mortgage insurance. So look at the payment and make a comparison. It's always good to look at one bank, one credit union, and maybe other credit unions too, because each credit union is unique. So if you belong to another credit union, check that out, and check out Self-Help as well as a bank.
And it's okay to shop. I mean, you're buying a house, you want to try to get the best possible program possible. So I do recommend that you shop to see who has the best program for you. It's okay.
It really is okay, because the first mortgage pull you do within a 30-day period, although do it quicker than that, because sometimes they don't pull your credit immediately, but keep those credit pulls together, and then it only counts as one credit pull. So people worry about losing a few points, but you're only going to use one mortgage pull if you keep it close together within a few weeks, 2 to 3 weeks.
And I think lenders generally want to see their credit report, because sometimes they can vary. So, you know, we're going to want to pull credit on you. So yes, if you're going to shop, go ahead and try to shop within that time frame. So you guys have my information. I may be a little bit slow to return emails and whatnot, but I will get to you. So if you have questions or you want to give me a call, please feel free to do so. The goal here is to try to get all of you to be homeowners, and we want to see that happen for you. So whatever we can help you with, just please reach out and let us know.
Well, thank you all so much. This has been really, really helpful. And if you're not quite ready to go to Chandra and give her a little space, then come to me or Angela or Rosa. She's doing counseling too. So we're all here to help. Anything else, Eliza, Chandra?